Hello and welcome to the 13th massive open online course by the University of Nicosia's Masters in Digital Currencies. This is week 6, session 6, and I'm Andreas Antonopoulos, and we'll be answering your questions from last week's material. So we have some great questions lined up, and the topic for this week is alternative uses of the blockchain and alternative blockchains. We're going to be talking about permissioned ledgers, distributed ledger technology, and private blockchains as well. Lots of great questions from you. Let's dive right in. Our first question today comes from Jorn. What's the point of having a private blockchain? A blockchain has an obvious advantage as a distributed data structure. However, what's the point with having a private blockchain with one centralized party in full control? Can this party not replace the blockchain at any time? Yes, excellent question, Jorn. Really, the issue here is an issue of trust. So, if you think about decentralization and trust, we have to think of them not as an either or yes, no, or Boolean, but instead think of it as a range or spectrum. On one end of the range, you have our current traditional financial system, which involves a high degree of centralization and requires a high degree of trust in a centralized party or a handful of centralized parties. So for example, let's say you're doing equity trading, then in that environment, there are a number of key parties in which trust is placed in the system, such as the clearing organization that is responsible for clearing trades in equities. Now, in the US, that's actually a private corporation that is chartered to do that, the Depository Trust and Clearing Corporation, DTCC in New York, and that organization is a private organization. Now, they are under oversight, which is the mechanism you have to reduce trust in centralized systems, reduce the need for trust. Now, let's go all the way to the other end of the spectrum. The other end of the spectrum is a completely decentralized and peer-to-peer system where trust isn't needed. A great example of that is cash. If I meet someone and I give them $1, they don't need to know who I am. They don't need to trust me at all. They can examine the dollar and decide that it is valid and real, and they've got a decentralized, trust minimized or trustless solution. I prefer the term trust minimized because there's always some trust involved. There's a tiny bit of trust, for example, in being able to validate whether a dollar bill is real or not. That requires some trust in the treasury that prints the dollar bills, that they do their job well and they're difficult to forge. Bitcoin, as an example of such a blockchain, is on the trust minimized side, often called a trustless system, although you have to trust that the software you installed is properly configured and that the network is operating as expected, and that requires a bit of trust. You have to at least trust your own skills. You have to put some trust in the network operating properly. But it's very, very trust minimized, and you're not trusting in one person. You're trusting in an entire process that involves many, many steps and many, many eyes. So a blockchain that is public, open, and decentralized is on the trust minimized side. So what's the point of a private blockchain? Well, very often a private blockchain falls somewhere on the spectrum, probably closer to the centralized trusted party system, but not all the way at the point of centralization. So if today, for clearing equities, for example, you have one party that you have to trust, which is a private corporation with some oversight, and you replace that with a blockchain that involves validation through a consensus network of trusted parties that sign blocks, also known as a proof of authority consensus model, then instead of trusting in one party, you're now semi-trusting 5 parties or 4 parties or 10 parties not to collude with each other. And that reduces the amount of trust you have, and it increases the decentralization. 5 is more decentralized than 1. Now, it's still not a trust minimized system. It's still not approaching trustless, and it's still not really that decentralized. In fact, it creates a number of problems because private blockchains often have as participants people who have skin in the game, where they have profit incentives to game the system and to collude. So at least in the case, for example, of a clearing company or a stock market operator that themselves are not market makers or traders in that market, you have an independent party. If you replace that with a consortium of 5 banks, and all of those banks are market makers and traders in that market, that may not be as secure a system. So you have to consider what you're losing there. It might be better to also have, as part of the validators, independent parties that are not actually participating in the market. But all of those systems are basically on that spectrum of trust. To me, it's not a question of whether private blockchains are useful or not useful. They are useful to the people who are implementing them, and they may introduce a degree of efficiency and an increase in transparency and a decrease in the amount of trust you have to have, a decrease in the amount of centralization. To me, that's a marginal issue. Allowing the already well-positioned participants in the financial system to gain a slight degree of efficiency and transparency is great. It's an improvement over what we have now. But what it isn't is revolutionary. It isn't massively disruptive. It isn't completely changing the basis of the system to open it up to potentially billions of participants all across the world in an open system where trust is minimized tremendously and where decentralization is taken to a degree it's never been taken before. That kind of system has revolutionary implications. So it's not a matter of whether private blockchains are useful, because they are useful to the participants. It's more a matter of whether private blockchains are interesting enough for different people to be interested in participating in them. And honestly, for me, when I'm looking at the entire technology space between open, public, and decentralized blockchains and private blockchains, I find private blockchains boring. I don't think that they are a massive improvement. They are simply a small branch of distributed systems and databases that are a slight improvement over what we have now, whereas the space I'm really interested in, the technology of open, public, transparent blockchains that are fully decentralized, is incredible. So it's more a matter of interest. All right, some follow-up questions on private blockchains. Poe asks, I have 3 questions on the subject of enterprise, private, or permissioned blockchains. In a private permissioned blockchain, does mining or proof of work become redundant? Who does the mining in a private and secured network? In a private blockchain, can it be altered to send regular fiat currency instead of cryptocurrency? And finally, can a blockchain interface with general accounting ledgers? Well, let's take each one of those questions in turn. First of all, when we talk about private blockchains, we have to generalize the concept from mining and start talking about consensus. Mining is a particular mechanism for achieving consensus. It's not the only mechanism that exists. In fact, before mining or proof of work was invented and repurposed then by Satoshi Nakamoto to be used as a consensus algorithm, other consensus algorithms already existed. Byzantine fault-tolerant consensus algorithms for distributed systems already existed. A variety of them. And in fact, proof of stake already existed and had been used in systems before. In fact, proof of work was invented as an improvement over Byzantine fault-tolerant or proof-of-stake systems in order to increase the degree of decentralization and to minimize the amount of trust. An alternative mechanism, really, and proved to be rather successful. So in a permissioned blockchain, who does the consensus? And that really depends. You can configure it any way you want. We'll see some examples in subsequent questions when we talk about specific types of permission ledgers, but as an example, you can think of using a permission ledger such as Hyperledger. And in that case, you can plug in consensus algorithm that suits your needs from a variety of consensus algorithms. Really, the categories of consensus algorithms, I would guess, fall mostly into three broad categories. There are systems that involve proof of work, which is a novel mechanism introduced by Satoshi Nakamoto. There are systems that involve proof of stake, where some kind of native or external currency is being positioned as collateral in order to trust the participants to validate the rules correctly and participate in the consensus algorithm. Again, both of those systems involve a game theoretical system of reward and punishment, both in proof of work and in proof of stake. The consensus participants put some collateral down, energy in the case of proof of work, or work as it's called, or in the case of proof of stake, some currency, and they then promise on the basis of that collateral that they will follow the rules. If everybody agrees that they have followed the rules, they may receive some kind of reward. In the case of proof of work, that's the block subsidy or transaction fees. In the case of proof of stake, it might be transaction fees plus some kind of block subsidy, again, from the issuance of new currency. If they fail to follow the rules, there is a punishment. In the case of proof of work, you have spent the money on the work, you get no reward. In the case of proof of stake, you get no reward and you've locked up your money for some time, and potentially you lose some of the stake that you put in as a penalty. There is one more broad category, which is broadly called proof of authority. And proof of authority is a system of partial trust. What that means is you identify a number of participants in the system who are part of the consensus network, and they are authorized and they have authority to participate in consensus. So this means you have to vet them and identify them. So you say, okay, JP Morgan Chase, Wells Fargo, Citibank, Bank of America, these 5 banks or whatever are part of the consensus algorithm, and they're identified by these public keys, and they will take turns signing for blocks, which is one way of doing it, or you randomly select from that pool, and then one of them has to organize the block and sequence transactions, or you do proof of authority on transactions directly without having blocks. So on a per transaction basis, the participants in the system will sign that transaction to validate it. And this involves no stake and no work, but it involves authority. Very commonly, private blockchains use proof of authority. It is fast, it is efficient, and it's cheap. It also doesn't deliver the same security guarantees as proof of stake or proof of work. So in terms of security guarantees, with a proof of authority system, you do not effectively have finality because the participants can collude and at zero cost can violate the rules of the network or change the rules of the network anytime they want. In proof of stake, you have some degree of finality where the participants can collude to change the rules of the network going back, and if everybody else agrees, they can even change the rules going forward. So they can rewrite the past, and they can potentially change how they operate the network in the future if the other participants also agree. So because more parties are validating in a proof of stake system, and because there is a penalty if the blocks are not accepted by the other participants in the network, a proof-of-stake system holds the participants in consensus with more accountability. Finally, I think a proof-of-work system has a qualitatively different degree of finality and immutability, because in a proof-of-work system, even if 100% of the consensus participant, all of the miners, all of the mining pools, agree to go and change the past, they still have to do the work, meaning that they still have to produce valid proof of work, which means they have to do the hashing, which means they have to spend the electricity, even if 100% of them are working together, because otherwise the rest of the network will not accept those blocks. And that means there is a cost to changing the past, and that can be a very significant cost in terms of energy, and that makes it very difficult for proof of work participants to change the past. That creates immutability, a different quality, immutability that is guaranteed by the expenditure of energy and has significant cost the further back you go into the past. As a follow-up question here, someone asks, is proof of authority similar to delegated proof of stake? No. Delegated proof of stake is more like mining pools in proof of work, meaning that with delegated proof of stake, what you can do is you can say, I will have that party over there take my stake vote and use it to vote in a proof-of-stake system. So I will basically allocate my stake and give someone else the ability to validate with that stake and stake that money on my behalf and vote essentially on the security of the network. So it allows people to pool their stake in a way that they give it to someone else without actually giving the funds to someone else. It's not a proof of authority system. In proof of authority systems, there is no stake. There is no monetary or energy investment behind the authority. The authority itself is what validates the system, which means that it is a system of trust, partial trust, but still trust. The second question from Poe is, in a private blockchain, can a private blockchain be altered to send regular fiat currency instead of cryptocurrency? Yes. You can put whatever kind of tokens you want on a private blockchain. In fact, some private blockchains don't have a native currency at all, and you would have to implement it, as we'll see in a subsequent question. However, one of the challenges with doing this with fiat currency versus a native cryptocurrency is that when you're dealing with a fiat currency and not a native cryptocurrency, the fiat currency is external to the system, meaning that when you create a token that represents that fiat currency, there is a degree of risk, because in order for that token to be valid, you have to have the fiat currency in reserve vis-a-vis that token. Otherwise, it's not connected really to the fiat currency. It's a cryptocurrency of its own. Its value is native to the blockchain. If it isn't an intrinsic asset, meaning one that is born and operates within the blockchain, but an extrinsic asset like fiat, who holds the fiat? Well, the fiat is held in bank accounts, and those bank accounts are subject to counterparty risk. First of all, you have counterparty risk in the form of the bank. The bank may go bankrupt, and then where's the fiat? The fiat is not guaranteed in its full amount. Maybe some banks have some kind of deposit or insurance, but certainly not to the degree that would back a fiat-backed cryptocurrency. Additionally, you have counterparty risk because governments can come in and seize or freeze or confiscate or block these assets for a variety of reasons. So if the fiat behind your token that you have on your private ledger is seized, well, then you have no backing for that token, and that can lead to a catastrophic collapse in the value because it is no longer collateralized, essentially a loss of confidence in the market. So this problem exists again with stablecoins, which are another way that blockchains will attach to a fiat currency. And the problem with stablecoins is that the externalized asset introduces counterparty risk. In the case of a cryptocurrency, of course, the cryptocurrency itself running on the blockchain operates entirely within the rules of consensus. And if you trust in the rules of consensus, you don't have additional counterparty risk introduced by an external asset. Finally, Poe asks, can the blockchain interface with general accounting ledgers to reflect the transactions made in the blockchain or vice versa? Of course it can. You can take information from a general accounting ledger and use a mechanism called an oracle. And an oracle is a mechanism for introducing information from the world outside of a blockchain into the blockchain system. Of course, that introduces issues of trust because you then have to trust the oracle to correctly reflect the information from the real world. You can also take blockchain information and reflect it in an accounting ledger. We all do that every time we file our taxes, for example, on the capital gains that we might have, or capital losses, or our general accounting based on Bitcoin transactions. We take all of the Bitcoin transactions that we've done, we create an accounting ledger that reflects those Bitcoin transactions in terms of US dollars, and we submit that accounting ledger to the US government in order to pay taxes. So effectively, both of those things are possible, but of course, in the case of reflecting accounting ledgers into the blockchain, again, you're dealing with the fact that because those accounting ledgers outside the blockchain are not intrinsically under the rules of consensus, they're not an intrinsic asset, you have to depend on a source of truth to put true information into the blockchain, and that's an oracle. And that introduces counterparty risk. All right, quick break. Let me know if you can hear me well, if sound and video is okay. Let me know in the chat. Hello, everyone. And we'll continue in just a second. All right. To follow up with a question that's relevant to the conversation we've had so far, Dan asks about the oracle problem. Is blockchain technology as applied to the physical world overhyped due to the oracle problem? People wax poetic about a trustless society with provable supply chains and token representing things like real estate or jewelry or art, etc. However, when data touches the physical world, it seems we have to trust people to correctly enter that data. At best, it can marginally improve these areas, but not revolutionize them as it can with end-to-end digital money. Is that correct? Dan touches directly and very astutely on the problem we were just discussing, the difference between intrinsic assets that are always subject to the consensus rules and where the only degree of trust you need is in the system that implements the consensus rules, which you are already trusting anyway, versus extrinsic assets where you need to simultaneously trust the intrinsic rules that govern the token and the consensus rules that affect the blockchain in which the token is recorded, the transaction security of that system, etc., etc. And you also have to trust some external system. Now, that external system is varied. First of all, you have to trust oracles. Oracles are the gateways that take information from the outside world and reflect it into the system. We've already seen systems that take advantage of problems in oracles in order to compromise assets that are tokenized on different blockchains. So what is the risk there? First of all, the oracle may reflect incorrect information, or the oracle may be disrupted in such a way as to delay the appearance of information that is critical to the market. Imagine, for example, if you have an Oracle price feed that is representing information about an external asset that you're trading, for example, a stablecoin that represents a fiat asset, and that stablecoin maybe is collateralized, and the collateralization percentage that you use for that stablecoin depends on the exchange rate of that particular cryptocurrency vis-a-vis fiat. That means that the Oracle is giving you information about the exchange rate, and based on that information, the degree of collateralization you need in your stablecoin changes over time. You may end up finding yourself under collateralized, or you may end up having a surplus. Now imagine if that Oracle can be disrupted because it's too centralized, such that it either reports incorrect information or, more simply, is simply delayed. If you delay the reporting of pricing information into that smart contract, what happens is that you can arbitrage the difference between what is actually happening in the markets and what the Oracle that is delayed thinks is happening with the markets. You are trading within the blockchain at the price the market reflected 10 minutes ago, an hour ago, a day ago, whereas the market in external systems that you might move, say, your stablecoin, is trading at a different price. Well, that difference in price, even if it's very small, even if the delay is very small, creates an opportunity for arbitrage, which means you buy at the lower price, you move the thing outside of the blockchain, you sell it at an external market where its price is marginally higher, you make the difference, and you recycle the funds as quickly as possible. It depends on how quickly you can do that. It depends on how much liquidity there is in these markets. It also depends on how big the spread is. But even a small spread, if you are able to use through perhaps leveraged finance, or recently we've seen flash loans, you can actually put a lot of money through that pipeline, make a very, very substantial profit, and create damage to the market, because obviously someone is losing in those trades. This is an example of something that not only is a theoretical possibility, but has been exploited in decentralized finance products, as we'll see when we answer the next question. The Oracle problem is just one of the problems, because the even bigger problem you have is the issue of collateral and hypothecation. Hypothecation comes from the Greek word hypotheki, which means the putting something under storage, effectively putting it in storage, and then issuing some collateral against it, or controlling the item in storage and securing it while you allow it to be traded. So for example, when you buy gold certificates on the stock market, you're buying gold certificates that theoretically represent gold that's in a vault, hypothecated by someone. The risk there is a specific thing called rehypothecation, which means that the person who has the gold sells the 1 ounce of gold they have as a certificate of 1 ounce of gold to you, but they then go and they sell the same gold again with another certificate to someone else. So essentially they create a fractional reserve system, or they use that gold as collateral to take out a loan. So now there's two claimants on that gold, the person who has the certificate, who is theoretically the owner, but that gold now also has a lien on it because it's being used as a loan. It's difficult to audit these kinds of situations, just like with stablecoins. When you have fiat in the bank against a stablecoin, not only do you have to audit that the fiat or gold is in the warehouse, essentially audit that the assets are there, but you also have to audit the organization and all of its convoluted subsidiaries and financial arrangements to make sure that there aren't liabilities such as loans that are leveraged on top of the asset, therefore invalidating that asset, because net assets are what underpin your token or certificate, whereas that net asset may be much less than the physical assets that are in there because of the liabilities that have been raised against them. Difficult to audit, which means lots of opportunities for fraud. And rehypothecation fraud is probably one of the most common mechanisms that people abuse markets, especially markets in things like commodities, precious metals, but even common metals like copper and steel, and commodities like oil and pork bellies. Because it's so difficult to audit the holders of the physical asset, the tokens like stock certificates or commodity certificates that are being traded on markets already have that risk that there aren't enough pork bellies, there isn't enough gold, there isn't enough steel to actually match the certificates that have been issued. This is a known problem in markets, and it doesn't get any better if you put it on a blockchain. You have the exact same risk, only now you also have the risk introduced by the consensus mechanism over the token itself. Not only can the gold, pork bellies, or dollars not be in the appropriate warehouses and accounts, but the token that represents gold or dollars may get hacked, and that's an additional risk. So yes, the idea that we can simply tokenize everything and we will actually create an increase in trust and transparency is problematic. The enormous advantage that comes from dealing with purely intrinsic assets like cryptocurrencies, Bitcoin, Ether, and other cryptocurrencies, where the currency itself is governed entirely by the rules of consensus. There is no other reserve or liability or way to stop, freeze, or interrupt transactions. That in itself has tremendous value because that represents a market in which there are no obvious or high risks from counterparties, from collateralization, hypothecation, fraud, seizure, etc., etc. All of the risks are only those that exist within the consensus algorithm. That's why these assets are so interesting. Now, that doesn't mean that this isn't a better mechanism than a stock market or commodity market for pork bellies or gold. It might actually be a better mechanism because here's the other problem. In the traditional gold markets where you have gold certificates, one of the problems is it is impossible to even find out how many tokens are out there. It's impossible to find out how many certificates have been issued. Because these markets are very fragmented, because the oversight and clearing is handled by a single company, and their books are very often very poorly managed, you have a gap between the actual amount of certificates that are issued and what is being reported. The gap is famously called the bezel, short for embezzlement. This is a real problem in markets. It exists in many, many different markets. With tokens, you might be able to improve on that. At least you can go into the blockchain and using its transparency mechanisms, you can count all of the tokens that exist vis-a-vis the gold that should be in the warehouse. You still have the problem of auditing the hypothecation of the underlying asset. You still need to make sure that the jewelry, the gold, the oil is in place. And that's a big problem, but at least you don't have to worry about knowing how many certificates have been issued, because if the only way that thing is tokenized and the only token that's recognized is the one that's on the blockchain, you can go and transparently count how many of those have been issued. There's other problems, of course. We have to think about the trade-off between privacy and security. If you have a zero-knowledge protocol, then you can't actually count the tokens either, and that's another big problem. But, these are all issues about balancing the various trade-offs. What are you trying to achieve? Trust minimization, transparency, auditability, liquidity, velocity, all of those things play. And so different blockchains, especially different private blockchains and open decentralized blockchains, are trying to find sweet spots in these trade-offs where these sweet spots align very nicely with specific applications or solve problems in specific markets in a way that benefits the participants in these markets. Some will succeed, some will fail. It's a great point to jump in to the broader topic. Now that we've covered intrinsic assets and private blockchains and oracles, all of this comes together in DeFi. So decentralized finance, or DeFi, is a very big topic nowadays. Ludwig asks about Ethereum, smart contracts, oracles, and DeFi. Ludwig asks, any thoughts on the recent DeFi developments, as this is a really good example of smart contracts into play, including the use of oracles. Increasingly more money is being locked. One of the metrics, by the way, is TVL, total value locked, is locked into DeFi, looking at it from a year-to-year perspective. Recently, more than $1 billion has been locked into decentralized finance contracts. That then is used for lending, liquidity in decentralized exchanges, derivatives, payments, etc., including arbitrage. So we did talk about some of these issues broadly. We've covered most of the basic topics. Let's look at this DeFi space in more detail. First of all, a quick example, probably the first and pioneering project in the DeFi space that kind of defined the space and was an early success in this space, is a stablecoin called DAI. Which is created by a project called the MakerDAO. MakerDAO is a project that uses a mechanism called a collateralized debt position to allow you to take a stablecoin loan by collateralizing Ether. Recently, that project moved to a multi-collateral system, so you can collateralize all kinds of Ether-based tokens, including Ether, in order to acquire DAI. DAI is a stablecoin. It's pegged to the US dollar, which means that one DAI is $1. That makes it easy to use in merchant applications and retail applications, especially in the US, because people understand it as a unit of account and can use it flexibly as a medium of exchange. The interesting thing about DAI is that DAI is created by putting Ether into reserve at a collateralization ratio. For example, let's say you want to take out one Ether worth of DAI. So let's say, for example, today 1 Ether is worth $200. So you want to take out 200 DAI. You have to collateralize more than its face value in order to do that. Let's say the current collateralization ratio, which changes, it's a network parameter in the MakerDAO system, is 150%. That means that if you create a collateralized debt position contract or CDP contract, which you fund with 1.5 Ether, you can then take out 200 DAI, or 1 Ether versus worth of value from that contract, and then spend that DAI or do something else. Ironically, one of the things you could do with that DAI is buy Ether and put it back into your collateralization contract. Some interesting things happen there. The purpose of this is to allow you to essentially create, to enable liquidity without selling your Ether, and also underpin a stablecoin. DAI is just one example of these decentralized finance projects. There's also a number of projects that allow you to do various forms of loans. There's decentralized exchanges where you can exchange various tokens, and some of those combine with decentralized collateralized loans to do margin buying of other tokens. You also have a recent development in this space, which is the concept of a flash loan. A flash loan is where in a single transaction you borrow Ether, do something with it, and then return that Ether back. And as long as that contract, the contract execution that happens in that single transaction, as long as that single transaction produces the events that return the original loan, it will go through. It's a valid transaction. Now, what that allows you to do is rather interesting because you can take a very, very large loan. You have no collateral, and as long as at the end of the transaction that loan goes back, you can use that to do things in other smart contracts. Recently, that was exploited. The way it was exploited was rather ingenious and demonstrated both the power of decentralized finance and the pitfalls of decentralized finance. This is a brand new space and a lot of interesting things are happening. So if you want to read about that, read about the flash loan exploit that happened about a week or two ago, and it's fascinating. The bottom line is that someone took out a very large loan of Ether, and in the same transaction took that Ether as a flash loan, split it into two parts, turned one part into wrapped Bitcoin, turned the other part into a short sell on a decentralized exchange of wrapped Bitcoin, sold the wrapped Bitcoin, at the same time liquidated the short and made a profit, took the money out from both of those, put it back into the flash loan, and in a single transaction returned the loan. The attacker made $350,000 from this arbitrage, essentially, situation. It's an auto pump and dump in a single transaction. Ingenious to do it in an atomic transaction. It's even difficult to use the word attacker in this scenario. Are they an attacker, or did they execute a perfectly valid financial transaction under the rules of the system? It's a very, very gray area. It's unclear whether this is a good use or not. Clearly, it was disadvantageous for the participants in that transaction who lost money. And many of the exchanges involved and the systems involved changed some of their rules, so they can't so easily be gamed in this kind of arbitrage. But nevertheless, a fascinating example produced by DeFi. Of course, that's not the only use. There's a lot of interesting uses coming out of DeFi, and at the moment, $1 billion in the crypto system, and especially in the Ether system, is a very large amount of money. In the broader financial space is a tiny amount of money, and therefore this is on the cusp of getting interesting in a broader financial sense, but it's still a very experimental early stage thing, from the bigger picture. So in Ethereum, these are great demonstrations of what you can do with the flexibility of smart contracts. And depending on your position on whether smart contracts are a smart thing to do or not, you may see this as a fantastic development, or you may see it as a laughable example of what goes wrong when you have essentially JavaScript programmers playing around with finance. I think it's both. I think that simultaneously we're seeing some of the dangers of relying on fairly naive implementations, immature implementations of code that are moving very, very fast with unstable interfaces and expectations, untested, with bugs, and all of this move fast and break things culture that comes with Ethereum. That's the dangerous part. But of course, what that enables is the very, very rapid iteration and maturing of some very interesting examples of what could be the basis for a revolutionary set of financial instruments that have never existed before. We're beginning to do things that are not simply analogs of traditional finance, but are things that simply cannot be done in traditional finance, and that's real innovation. So it's a double-edged sword. That's what I think about DeFi. It's a double-edged sword. It is immature, experimental, and a bit reckless, but at the same time, it is allowing us to explore some of the greatest elements of innovation that can come out of this space. And if you're willing to take the risk, it can be both interesting technologically and also interesting financially. So I'm going to continue to observe that space and try to learn as much as I can, both from the successes and from the failures. All right, let's look at the other side of that particular equation. Stephen says, skeptical. I'm sorry, I'm skeptical of any blockchain other than BTC Bitcoin, as it has proven to be the most decentralized and most secure and stable as money or store of value. To back that up, Stephen has a couple of questions to check that skepticism. Stephen asks, cannot infinite second layer technologies be secured by Bitcoin? I don't see how any other blockchain provides sustainable, groundbreaking, or revolutionary technology other than maybe and hopefully decentralized, trustless, non-custodial social media and also privacy and property rights of data. So Stephen doesn't see the potential for groundbreaking or revolutionary technology here other than social media, privacy, property rights over data. Well, first of all, that could be even bigger than you can imagine. But secondly, to the specific question you asked, cannot infinite second layer technologies be secured by Bitcoin? Yes and no. Yes, you can secure infinite second layer technologies by Bitcoin, but the security that is offered goes down to the security consensus rules of Bitcoin. This is almost exactly the conversation I had with Ethereum's founder in 2014 when I asked that exact question. Why not just do it on Bitcoin? Why can't we just do smart contracts on Bitcoin? And the answer is subtle, but also becoming more and more clear. The issue here is that in a system like Ethereum, the validity of the smart contracts and the deterministic execution of those smart contracts with all of their complex interactions is under the consensus rules. If you build a second layer that's secured by Bitcoin, the range of activities, the range of smart contracts that you could implement on such a system is limited by what you can do under the consensus rules of Bitcoin, or it is no longer secured by those consensus rules, meaning that the consensus rules of Bitcoin are narrow on purpose in order to provide this very, very robust, very secure, very simple and thus very secure system that creates robust money. Great. And you can do some interesting smart contracts. You could do smart contracts so that you can, for example, build payment channels, which are things like the Lightning Network. And of course, those smart contracts give you the ability to take the fundamental security offered by the consensus rules for payments and the trust you can put in that, and leverage it to create faster payments, cheaper payments, secure and private payments at a much different degree of scale. All good, but that doesn't mean that you can simply extend from payments and do something else, like, for example, something like we've seen in stable coins with collateralized debt positions and things like that. You can't do that kind of complicated smart contract because Bitcoin's scripting language cannot express that level of complexity on purpose. So either that smart contract is not under the consensus rules of Bitcoin, in which case it's not being secured by Bitcoin. That means that you have to rely on something else to do the security, or you're limited in what you can do. That's the trade-off. And so the thing about Ethereum and platforms like it that extend into smart contracts or have other applications that require more complexity and flexibility is that the rules that control the smart contracts are the consensus rules. And you can't do that on Bitcoin. You don't want to do that on Bitcoin. Introducing flexible smart contracts into Bitcoin breaks its security model. And trying to do the very, very simple, robust security of Bitcoin breaks your ability to do smart contracts. So you have to choose one or the other. You can either have it simple and robust, or you can have it flexible and expressive. And that's the choice that's represented by other blockchains than Bitcoin. There are other applications of money, but even in the case of money, there are applications that are worth exploring of a degree of complexity and expression that surpasses what the Bitcoin scripting language. At least that's my opinion. Now, of course, that can only be proven one way, and the only way it can be proven is by building those things and then operating them under adversarial conditions with money on the table and with all of the security problems that come with that, and gradually increasing the maturity. Now the question is, do examples of thefts, whether those are thefts from exchanges in Bitcoin because of problems with key management, or thefts because of bugs in smart contracts in Ethereum, invalidate the architecture completely, or are these simply growing pains, and gradually as the maturity increases, we can do bigger and bigger and bigger experiments with more collateral and more flexibility as components that are used extensively and for a long period of time under adversarial conditions become mature enough to support more complex operations. That is the fundamental question that needs to be answered, and we don't have the answer. And the only way to answer that is to continue the experiment and see how it goes. A lot of people are very skeptical, as in, these systems will never become mature enough to enable these complex expressions without sacrificing security. Other people believe they will become mature enough and the components over time will become more and more robust as they are tested under adversarial conditions. On the basis of that opinion, you might decide you are only interested in Bitcoin or also interested in other blockchains. I'm certainly interested in the technology, if not the investment, and that means that I'm interested in exploring how this technology works and how these design trade-offs will play out over time. All right, the next question is about Hyperledger. Ralph asks, when looking at this week's slides, it appears to me the Hyperledger umbrella project has a huge pipeline of very interesting and advanced projects in the blockchain space. Why is it that these are not so much popping up in common blockchain news channels and communities as are Bitcoin, Ethereum, and Ripple? How is a Hyperledger blockchain running in terms of consensus algorithm? And is there a native Hyperledger coin? I can't find any on CoinMarketCap. It's a great question, Ralph. So what is Hyperledger? Let's talk a bit about that. I think first and foremost, it's important to understand what Hyperledger is. Hyperledger is a project and simultaneously it's a platform for building blockchains. Hyperledger is not a blockchain. Hyperledger is a platform, a tool set that is open source that allows you to build your own chains and configure them to do what you want. So it's a factory, it's a chain building factory. There is no Hyperledger blockchain. There are many blockchains that are built using Hyperledger, and those are primarily distributed ledgers or permission ledgers, meaning private blockchains, and they operate by building on top of the Hyperledger platform, or they're built from the Hyperledger fabric. So Hyperledger is a factory fabric toolkit code base that you use to build other chains, and those other chains are called whatever. They might be called JP Morgan coin, or they might be a real estate project in Dubai for tracking real estate title, or whatever it may be, and they'll have their own name. What is the consensus algorithm? Well, the consensus algorithm in Hyperledger is pluggable, meaning that you can choose when you build your chain to implement different consensus algorithm. So in Hyperledger, there's the concept of chain code. And chain code is essentially the building block or recipe that defines how your Hyperledger-based blockchain will work. Chain code could involve smart contract execution, and within that you might build a currency, and within that you might implement a consensus algorithm. For Hyperledger, there are actually a whole host of consensus algorithms you can use. Byzantine fault tolerant, or BFT algorithms. I believe there's one called simple BFT. There are various proof of authority consensus algorithms where you have authorized vetted participants who participate in consensus and sign the various blocks or transactions. Kafka, I believe, is the name of one of them. There are a few others that are being used in Hyperledger. I don't remember all of the names. So basically imagine this as a series of tools or building blocks that you can put together in a particular recipe to build a blockchain that then operates based on the recipe that you provided it. You could build a proof of authority system with a native coin. You could make that native coin be used for fees, and you could have any kind of proof of authority or other consensus algorithm configuration that you want for your solution. So, is there a native Hyperledger coin? Yes, there are any native coins you want to create. So Ralph, if you want to, you can go out and get the Hyperledger fabric, and then you can build Ralph coin, which is the coin that you use for your implementation in the chain code definition of your Hyperledger-based blockchain, which you may call Ralph chain, which runs with Ralph coin and uses a proof of authority where all of the blocks are signed by Ralph and Ralph's cousin. That's a perfectly valid chain, and you can build that with Hyperledger. In fact, the whole point here is that it should be easy to build that and deploy it with Hyperledger, and it should work in a predictable manner because it's a well-tested and well-developed project. Hyperledger is open source. You can go and find it online, and you can start building projects with it right away. The reason it doesn't show up in most of the news and discussion that is happening in the cryptocurrency space is simply because Hyperledger isn't a cryptocurrency, and because the vast majority of the projects that are being built on Hyperledger, if not all, are private ledgers. They're decentralized ledger technology, permissioned blockchains, etc., etc. And for the most part, they're being used to build proof of concept implementations. These proof of concept implementations are usually very closed permission systems attempting to reconcile the physical world with the blockchain world and to implement incremental, not particularly daring, not particularly innovative improvements over traditional financial services, traditional asset registration services like real estate stuff, and commodities and things like that. And, mostly I think that platform tends to be used by organizations, companies, and government organizations that are trying to approach the blockchain space in a rather timid fashion. And what they really want to do is business as usual, where they remain in control. And Hyperledger is a quick way to implement and experiment with that. All right, and the final question for today Ethereum legality and admissibility in court. In the section covering smart contracts, one of the bullets reads, legality and whether smart contracts are admissible in court are questionable. Could this be elaborated on? Asks Austin. Why not? What if I had proof of a hash for some digital intellectual property that I've recorded on Bitcoin or Ethereum dated earlier to someone else's claim over that intellectual property? And Austin mentions here patents. In the US, at least, prior art and patents doesn't matter, but copyright might be a valid use case for this kind of thing. The bottom line, Austin, is that in order to make this a legally recognized contract, you would have to have a court case. That's really all that is at stake. In many countries around the world, what is required as a contract is very, very specific. So, for example, in some countries, it's specific to written contracts, or it's specific to contracts that have signatures on them. In other countries, the concept of a contract is much more flexible. In the US, for example, electronic signatures are recognized. Verbal contracts are recognized. If you make a verbal agreement, it's recognized. A contract, more or less, although I'm not a lawyer, simply involves some kind of promise, some kind of consideration. So it's offer, consideration, and acceptance, as it's called. I offer to do something. I do it for some consideration. There has to be some value or something exchanged, some other thing, and you accept that, and you demonstrate that acceptance in a variety of ways, by saying I accept the contract, by signing on paper, by signing with a digital signature, or by starting to use the service. In some cases, you've already demonstrated acceptance. So all of those things are contracts. Therefore, there's no reason why an Ethereum smart contract, as long as it includes offer, consideration, and acceptance, wouldn't be considered a legal contract. However, in order to enforce it, you would have to go to court, you would have to sue the other person, and then you would have to sit down and explain to a judge, usually in their 60s or 70s, about all of these things that they don't understand, which would be a very expensive proposition. This has not yet happened, and it has not yet happened broadly enough, at least, that I know of. And this would have to happen at a local level, then it would have to happen at an appellate level, then it would have to happen at a circuit level, in order for it to be broadly acceptable as a precedent that you could then use in another court case to enforce again and again and again and again, until it became routine and routinely recognized in the legal system, at which point you could say, yes, it's admissible in court. Whether it's admissible in court is a question you can only answer by admitting it in court. And if the court admits it, it's admissible, at least in that court. There is no such thing as admissible in court in a broad sense, other than through precedent. You have to go to court and do it. So it hasn't happened yet. I don't see any reason why it couldn't happen, especially in the US, where the definitions are broad enough. And that concludes the 6th session of the massive open online course, 13th semester for the University of Nicosia's master's degree in digital currencies. I'm your teacher, Andreas M. Antonopoulos. It's been an absolute pleasure answering your questions, and really, really great questions this week. And that's it for me. I hope to see you again soon. I hope you enjoyed and learned a lot from this session. Don't forget, ask your questions in the forums during the week so you can have conversations with your fellow students, so you can explore these topics before we get to the live stream Q&A. And that's when I get to answer whatever's left over from your exciting conversations. Thank you so much, and have a great rest of the week and weekend. Bye-bye.